Welcome to this video on the anatomy of corporate fraud, where we unmask the deception behind two major collapses, Enron and Satyam. We will analyze how these failures happened and discuss vital lessons for modern investors. This video will cover 4 key areas: an executive summary of the cases, key financial findings, strategic recommendations, and a future outlook on regulatory and investment growth. Both Enron and Satyam emerged during an era of unchecked optimism. In the late 1990s and early 2000s, the dot-com boom in the US and the IT outsourcing boom in India created environments ripe for rapid, often speculative, growth. Enron was hailed as the world's most innovative company for 6 years straight, with a peak valuation exceeding $70 billion in 2001. Its core business spanned natural gas, electricity, and commodities trading. Satyam was considered the crown jewel of Indian IT, boasting major clients and a vast global delivery network across India, the Americas, and EMEA. Its core services included ERP, application development, and managed services. These frauds employed different methods. Enron relied on special-purpose entities to shift debt off balance sheet, while Satyam fabricated cash and reserves, inflating their bank balances and financial reports. Both cases show how complex financial systems enable large-scale fraud. When false data is fed into models, it creates a false sense of security, ultimately leading to hidden risk and market collapse. Enron exploited mark-to-market accounting, which values assets based on fluctuating future prices rather than their stable historical cost. This accounting for quote-quote future dreams allowed Enron to book projected gains as current revenue. Enron used special-purpose entities, like Chuco and Raptors, to obscure transactions and hide massive debt off its balance sheet, making the company appear much healthier than it actually was. This created a toxic feedback loop. As Enron's stock dropped, the collateral in the SPEs failed, forcing Enron to issue more stock. This diluted market capitalization, causing the stock to drop even further. Satyam's fraud focused on fabricating the top line. They inflated revenue using obfuscated invoices and fictitious employees. Out of 53,000 reported employees, 13,000 were ghosts, resulting in a hidden shortfall. Satyam created a quote by forging corporate deposit receipts to conceal the fact that reported bank balances and accrued interest were vastly inflated compared to the authentic data points. The Midas entities, family-owned shell companies, served as a real estate squeeze. Authentic cash from Satyam's IT operations was diverted for investments in Midas Infra and Midas Properties. Comparing the two, the divergence effect is striking. Enron's restated debt was double the reported figure. Satyam's reported cash and bank balance of 5,361 crores was almost completely fictitious, with the actual figure being only 321 crores. The ultimate red flag for both was the divergence between net income and operating cash flow. A healthy company translates income to cash. When net income rises sharply but cash flow remains flat or negative, it signals manipulation. The system lockdown occurs when the fabricated financial figures can no longer be concealed. Data inconsistency is detected, leading to a critical exception and access denial. For Enron, the crack in the armor was Sharon Watkins' memo of August 15, 2001. She warned CEO Ken Lay that the off-balance sheet vehicles were designed to hide substantial losses, predicting a wave of accounting scandals. Enron's freefall was rapid. Following the memo, the stock price plunged from $90 to $40 after market shocks, then to $15 after earnings restatement, and finally to less than $1 when the SEC investigation began. In 2009, Satyam's B. Ramalinga Raju confessed to regulatory bodies that the company's financials did not reflect its actual position, stating he felt like he was riding a tiger without knowing how to get off. The confession caused panic on the Dalal Street. The Sensex and Nifty indices immediately fell over 6% due to severe market sell-offs, and Satyam's own stock price plummeted by 78%. Both collapses exposed the failure of external audit controls. Arthur Andersen audited Enron, and Price Waterhouse audited Satyam. Both auditors missed the monumental fraud, leading to their own downfall and the breakdown of public trust. A critical conflict of interest was the revenue derived from non-audit consulting fees. Both Andersen and PwC earned as much or more from consulting than from standard auditing, compromising the independence of their review. The Enron scandal led to the criminal conviction and subsequent dissolution of Arthur Andersen, a Big Five accounting firm. The firm went from employing 85,000 globally to shutting down completely. The collapse of Enron spurred the creation of the Sarbanes-Oxley Act of 2002. This landmark legislation mandates strict internal controls and executive accountability to prevent future corporate fraud. India's response was a masterclass in crisis management. Government agencies initiated a swift rescue operation, seizing control and ensuring business continuity to stabilize the company and the market. The process culminated in the rebirth of Satyam. Tech Mahindra won the open bidding process, absorbing Satyam and rebranding it as Mahindra Satyam, saving thousands of jobs. In India, the fallout led to significant regulatory tightening under the Securities and Exchange Board of India and the Companies Act. These reforms focused on board independence and auditor rotation. The economic damage from Enron was far greater, with over $74 billion in market cap destroyed. Satyam's market cap loss was lower, and crucially, 0 jobs were lost due to the successful government intervention. Today we have more tools to detect fraud. The modern anti-fraud toolkit includes forensic auditing methods, like Benford's Law for statistical anomaly detection, and AI for real-time transaction monitoring. Investors can use financial ratios to flag potential distress. A key indicator is the Altman Z-score, a formula incorporating 5 ratios to predict the probability of a company's bankruptcy. First, we must demystify complex corporate structures. Use a critical lens to understand legal entities, subsidiaries, and off-balance sheet arrangements to see where risks might be hidden. It is crucial to cross-reference diverse financial data points. Always compare reported financial growth against real-world indicators, such as CapEx, employee payroll, and physical asset expansion. While trust in auditor opinions and credit ratings is helpful, independent verification is vital. Look beyond the face value of reports and conduct your own rigorous analysis of the company's fundamentals. We must recognize the human element, which is the pressure for growth. This pressure can lead to ethical compromises and fraudulent activity when internal controls and governance fail. These lessons reinforce the evergreen principles of financial evaluation. Transparency, consistency, and rigorous cash flow scrutiny are the cornerstones of resilient investing. Thank you for watching this video.